Hello, everyone. Welcome to this Economics 101 presentation on central banks and monetary policy. A bit of a more complicated topic here, but we'll do everything we can to simplify it for you. The link between these and the markets, we talk about it often, so let's try to make some sense out of all of this. So first, let's get started. What is a central bank? Well, a central bank is a financial institution to which a government has given the mandate to apply monetary policies. So, who are the central banks? Where in Canada we have our Bank of Canada. In the US, the logo is bigger because it's much more important to the markets than the other ones. So, the Federal Reserve System. So, this is the central bank of the US. When we talk about the Fed, this is who we're talking about. And in Europe, you have the European Union, or rather the Eurozone, which shares the same central bank, the European Central Bank. So they're responsible of the Eurozone monetary policy. Could add to that the Bank of Japan, the Bank of England, but still central banks are independent. Of course, the governors are named by the government. So just like in Canada, where the governor right now is Tiff McClem, he was named by the federal government. But when they are named, once they are named, after that, they are completely independent to apply the monetary policy that they see fit. So their roles, first, if you take a bill from your wallet, you'll see that it's signed by the Bank of Canada. So they issue money and they set the short-term interest rates. So short-term is very important here. So this is what we call monetary policy, what they do with interest rates, but issuing money is the number one role. Oversee the functioning of financial markets and participate in the regulation of financial institutions, and act as a lender of last resort in the event of a systemic crisis. So remember that in March of 2020, when the markets were under pressure from COVID, you had the Federal Reserve coming out saying that, well, if any business wants to have access to credit and no one will lend to them, we will lend to it to make sure that we don't have a falling down of the economy. So this is exactly a lender of last resort role in the event of a systemic crisis. So their main objectives, so for the Bank of Canada, is to maintain inflation low, stable, and predictable. This is its mandate. So in concrete words, that means the inflation target is set at 2% within a range of 1 to 3%. And it can diverge from this range a little bit, but its job is to keep it within that range. So this is the Bank of Canada's mandate. In the US, you have two mandates: maintain inflation low between 1 and 3%. But notice here that we added promote maximum employment. So that translates into keeping the economic conditions as good as possible in the US. So this is the role of the Federal Reserve. So they have two roles compared to Canada's only one role. So their main tools, when I said short-term rates, is the overnight financing rate, which we call the key rate. And when we say overnight, it's really the rate of interest at which major financial institutions, just like the big Canadian banks, will borrow and lend for one day, really overnight, the funds among themselves, just to close the books at the end of each day. So the bank sets a target level for that rate. So this is what it decides. This target is referred to the bank's policy interest rate. So this is the leading rate or the key rate. They're all synonyms for this rate here. So to make it more simple, this is the Canadian yield curve. So those are the interest rates for all of the maturities of bonds on the market. So of course, it costs you more in interest rates when you want to borrow for 30 years rather than 10 years rather than 1 year. For now, this is where we're at. The overnight rate that the bank sets will have an impact on the short, the short part of the curve. So the lower left of the chart here. So the 3 months, 6 months, 1 month rates will tend to be around the level of the overnight rate, because when everyone expects the overnight rate to remain at a specific level for a long time, well, that means that interest rates for this period of time, so for 1 year, 2 years, will tend to stay around the level that is fixed for the overnight rate from the central bank. So it doesn't control the yield curve, but it has a whole lot of influence on how rates behave at the bottom of the curve. Quantitative easing is another tool. It's not actually new. It was used during World War II in the US, but it's been prominent since the financial crisis of 2008. So what is quantitative easing, or QE? You hear us talk about QE sometimes. Well, it's when a central bank buys government bonds. So that means that the central bank will print money to go on the secondary market, just like you and I would do, and buy bonds to raise their price. So the more you buy something, the more the price rises. So you raise the price of the bonds and you lower the return or the interest rate. So remember the balancing act between interest rates and the price of bonds. So if you push the price of bonds higher, well, interest rates here will be lower. So this is so effectively, the bank can influence the level of interest rates at differing maturities. So they will be buying bonds with 5-year maturities, 10-year, 20-year, 30-year, to keep those rates a bit lower. So since a picture is worth 1,000 words, here this is from the Bank of Canada's website. So we'll make that simple. So let's start within the blue circle on the left. So this is where the Bank of Canada, the central bank, prints money, buys from other financial institutions bonds. So when you buy those bonds, well, then you get out of the blue circle here, the bond yields decrease, so interest rates tend to fall. Best example here is if they do some QE and they push the price or the interest rate on the 5-year bond lower. Well, usually when you shop for a mortgage, this is for terms of 5 years generally. So the interest rate of the 5-year bond is strongly correlated with the 5-year rate that you can get on the mortgage. So when they do that, it's easier, costs less to borrow for a house. So you have more money in your pocket, more easy access to property. So that means that spending will increase, and then the economy heats up, and then you can reach more easily the 2% target on inflation. So this is what the banks, the central banks have been doing recently, keeping rates low to make sure that the economy keeps on going. And if the economy is strong, then that's going to be helping it push inflation higher towards its objective. So this is the dynamic of quantitative easing. So again, all of the actions of a central bank are called monetary policy. It can be expansionary if you want to push the economy further, or restrictive if you want to hold the economy back. So if we look first at an expansionary monetary policy and the impact on the markets, which is the most important thing for investors, well, if you want to blow some wind in the sails of the economy, well, you cut the overnight financing rate. So interest rates will be lower down the curve, so that's easier to borrow at the lower rate. So you do that, and or you do quantitative easing. So you can rise the level of quantitative easing. If there's none in place, you can install it. So that means that you will be pushing all of the interest rates along the curve lower. So injection of liquidity, lower interest rates, stocks really respond well to that. So that pushes the price of stocks higher. Since they're acting on interest rates will be lower. And again, interest rates lower, that means the price of bonds will be higher. So that's a tailwind for a bond portfolio. Real estate, if you have more economic activity going on, that's a positive. And lower interest rates, that also tends to push the prices of real estate higher. So it's doubly good for real estate. And natural resources, well, if you have a stronger economy, then you have more demand for oil, for metals, so that pushes the price of natural resources higher. After that, if you do the opposite, restrictive monetary policy, if let's say the inflation is starting to run too hot or the economy is running too hot, then the central bank will be hiking its overnight financing rate just to remove some liquidity from the economy, and it will reduce its quantitative easing size. So there being a rise in quantitative easing is going to be a pullback in quantitative easing, or even a fading out of this program. So that will be pushing interest rates higher pretty much on every point in the curve. So less liquidity, costs more to borrow. So that means stocks tend to react negatively to that. So that's a headwind on stocks. Interest rates higher, that means the price of bonds are lower. Real estate, well, less economic strength and higher interest rates, so doubly bad for real estate. And finally, natural resources, well, less economic activity leads to less demand for natural resources, so lower prices. So that summarizes everything I wanted to share about monetary monetary policy in central banks. If you're interested in following more of these Economics 101 presentations, you will find them at ia.ca/economy. Thank you, everyone.